Income is taxed at the federal, state, and local levels, and earned income is subject to additional levies to fund Social Security and Medicare, to name a few. Taxes are difficult to avoid, but there are many strategies to help ward them off. Here are 6 ways to protect your income from taxes. Make sure to subscribe to this channel and leave a comment. 1. Invest in municipal bonds. Buying a municipal bond essentially means lending money to a state or local governmental entity for a set number of interest payments over a predetermined period. Once the bond reaches its maturity date, the full amount of the original investment is repaid to the buyer. Interest on municipal bonds is exempt from federal taxes and may be tax exempt at the state and local level as well, depending on where you live. Tax-free interest payments make municipal bonds attractive to investors. However, municipals typically pay lower interest rates. Because of the tax benefits, municipal bonds' tax equivalent yield makes them attractive to some investors. The higher your tax bracket, the higher your tax equivalent yield. 2. Shoot for long-term capital gains. Investing can be an important tool in growing wealth. An additional benefit from investing in stocks, mutual funds, bonds, and real estate is the favorable tax treatment for long-term capital gains. For 2022, a married couple filing jointly would pay 0% on their long-term capital gains if their taxable income falls below $80,800 and, in the case of a single individual, below $40,400.40 for 2022, the zero rate bracket for long-term capital gains applies to taxable income up to $83,350 for married couples and $41,675 for single individuals. 5. A tax planner and investment advisor can help determine when and how to sell appreciated or depreciated securities to minimize gains and maximize losses. Tax loss harvesting can also offset a capital gains tax liability by selling securities at a loss. If capital losses exceed capital gains, the lesser of $3,000 of the excess losses or the net capital loss can be deducted from other income. Capital losses in excess of $3,000 can be carried forward to later tax years. 3. Start a business. In addition to creating additional income, a side business offers many tax advantages. When used in the course of daily business, many expenses can be deducted from income, reducing the total tax obligation. Especially important tax deductions for self-employed individuals or health insurance premiums, which are available if special requirements are met. Also, by strictly following Internal Revenue Service (IRS) guidelines, a business owner may deduct part of their home expenses with the home office deduction. The portion of utilities and internet used in the business may also be deducted from income. In order to claim these deductions, the taxpayer must conduct business to make a profit. The IRS evaluates a number of factors, outlined in Publication 535. Taxpayers who realize a profit in 3 of the last 5 years are presumed to be engaged in a business for profit. 4. Max out retirement accounts and employee benefits. Those who don't have a retirement plan at work can get a tax break by contributing up to $6,000, $7,000 for those 50 and older, to a traditional individual retirement account (IRA) in 2022 and 2021. Taxpayers who do have workplace retirement plans, or whose spouses do, may be able to deduct some or all of their traditional IRA contribution from taxable income, depending on their income. The deduction for IRA contributions is phased out for adjusted gross incomes at different levels. Higher in 2022 than in 2021, depending on whether claimed on a single taxpayer's return, joint return, married individual filing separately, as well as taking into account any participation by a taxpayer in another plan. The IRS has detailed rules about whether, and how much, you can deduct. Before the Secure Act, 401k or IRA account holders had to withdraw required minimum distributions (RMDs) in the year they turned age 70 and a half. The Secure Act increased that age to 72, which may have tax implications, depending on the tax bracket the account holder belongs to in the year they withdraw. The bill also eliminates the maximum age for traditional IRA contributions, which was previously capped at 70 and a half years old. 5. Use a health savings account (HSA). Employees with a high deductible health insurance plan can use a health savings account (HSA) to reduce taxes. As with a 401k, HSA contributions, which may be matched by the employer by payroll deduction, are excluded from the employee's taxable income, and individuals' direct contributions to an HSA are 100% tax deductible from their income. 6. Claim tax credits. There are many IRS tax credits that reduce taxes, such as the Earned Income Tax Credit. For the tax year 2021, a low-income taxpayer could claim credits up to $6,728 with 3 or more qualifying children, $5,980 with 2, $3,618 with 1, and $543. if none. There is also the Savers Credit for moderate and lower income individuals looking to save for retirement. Individuals can receive a credit of up to half their contributions to a plan, an IRA, or an ABLE account. Thank for watching our video. Don't forget to subscribe to this channel.